Hello everyone, this is Phil Yaeger and welcome today to our Facebook Live video. It is Saturday and today's date is, what's today's date? We're looking at the date? 27th of January. Month is almost over. It's amazing. Anyway. Gee, I heard myself. Anyway, today what we're going to do is we're going to look at some questions and, all right, this is what you're going to do. If you know the answer, all right, you will go to the, there it is. It says Megan joined. All right. So Megan, what do they type in where it says Y? Is that it? The comment box?
Yep.
All right.
Yep.
So if you know the answer, just put the answer in. And then if you are correct, the first one who answers it, you get, and by the way, make sure you declare this on your tax return. All right. You get a $5 gift certificate to Starbucks. Whoa. All right. By the way, you might have to add a little something to that. It doesn't include whipped cream. All right. So please keep that in mind. And, you know, it'll be a good review. And let's take our first question. All right. And here it is. Just listen to the facts. It says, first of all, Dunn, D-U-N-N, Dunn received 100 shares of stock as a gift from Dunn's grandparent. And the stock cost, oh, Megan, you wrote that down there. Megan is so kind. Look at that thing. All right, I'm going to read it from the computer. Dunn received 100 shares of stock as a gift from Dunn's grandparent. The stock cost Dunn's grandparent $32,000, and it was worth $27,000 at the time of the transfer to Dunn. All right, Dunn sold the stock for $29,000. What amount of gain or loss should Dunn report? Okay. By the way, I am here in Frederick, Maryland. I'm with my granddaughter. We're spending some time with her this weekend. All right. So that was the dog ringing his little bell saying, I want to go out. All right. So anyway, all right, this question deals with a gift. Now, I don't know if you remember this, but this is the rule. All right. All right. The rule says if you sell a gift at a gain, all right, the donee's basis is what? The donor's basis, right? All right. Now, if you sell the gift at a loss, all right, the donee's basis is the lesser of the donor's basis or fair market value at date of gift. But if you use, all right, the donor's basis to see if there's a gain and it results in a loss, or you take the lesser of the donor's basis or fair market value at date of gift, all right, and that results in a gain, what is the answer to this question? Okay? All right? All right. Now, Megan, are you getting any answers? Where would they show? Here?
Yep, they'll show. So go ahead and take a couple minutes, type your answer.
Type in your answer. All right. And by the way, if you answer in the next 2 seconds, a car. It's over. I'm sorry. That offer is over. Okay? All right. Let's look at this. I don't see any answers, but all right. Now, let's look at the situation here for a gift. All right. First of all right, Dunn is the donee. He's got 100 shares of stock. He got a gift from Dunn's grandparent, the donor. The stock cost Dunn's grandparent $32,000, and it was worth $27,000 at the date of the gift. All right. Now, Dunn sold it for $29,000. Now, if he sold it at $29,000, and we're assuming that's a gain, the donee's basis would be what? The donor's basis. All right. Now, what did Dunn's grandparent pay for it? $32,000. All right. And if the selling price is $29,000, does that result in a gain or a loss? A loss. So if we use the gain basis, it results in a what? A loss. All right. Now, let's see if there's a loss here. Once again, selling price is $29,000. If it's a loss, the basis to the donee is the lesser of the donor's basis, $32,000, or the fair market value date of gift, all right, which is $27,000, which is less, 27 or 32, 27. So we use 27 as the basis, and Dunn sells it for 29. Using the loss basis results in a what? Gain. So if that happens, The answer is there is no gain or loss on the sale of the stock. We didn't get any replies to that, did we, Megan?
Not on that one.
Okay.
So that one's no winners.
No winners, okay? There goes the old Frappuccino. All right, now, let's look at another one here. Next question. Megan, you want to show it on the screen? There we go. All right, now, this question deals with a Section 1231 asset. Now, do you know what a 1231 asset is? All right, a Section 1231 asset is an asset used in a trade or business that is held by the company for more than 1 year. And, all right, if you sell it at a gain, some of the gain may be long-term capital gain, all right, and some of the gain may be ordinary gain. However, all right, please remember, there's two different rules when we have a corporation selling this real estate and also, all right, versus an individual who sells it. Now, let me explain to you what we have here. We have Thayer Corporation, and Thayer is selling this asset for $220,000. And, all right, it was depreciated on a straight line basis, and it says here the asset's carrying value, all right, is $220,000. All right, so let's see what we have here. All right, if we take, first of all, the selling price, it is how much? $220,000. All right, and let's see what we have here. The original cost was what? All right, it was $200,000, and it says here that the building was depreciated, all right, using straight line basis, right, Megan?
Correct.
All right, now let's get the facts here, Megan. It says here, building was depreciated on a straight line basis, all right, it was sold for $220,000 when the asset balance net of accumulated depreciation was how much, Megan?
$170,000.
All right, that's not showing up, okay? All right, so let's recap here. Selling price is $220,000, all right? The original cost is $200,000, all right? And the $170,000 is left here, but the asset net of accumulated depreciation is $170,000. So the accumulated depreciation taken was $30,000, all right? If you take the cost of $200,000 minus the depreciation of $30,000, all right, the book value or carrying value is $170,000. We sold it for $220,000. There's a gain here of $50,000. Now, how is this gain going to be taxed? Well, we have a corporation selling the real estate, and notice it was placed in service for more than 1 year. And when a corporation sells real estate, all right, which is a Section 1231 asset, all right, they have to recapture 20% of the depreciation taken. And when I talk about recapture, I'm saying how you treat it, which is at how much of the gain is ordinary income. Well, under Section 291, if a corporation sells real estate, 20% of the depreciation taken, all right, now let's get the depreciation taken. The depreciation taken was $30,000. 20% of that 30 is $6,000. So $6,000 of the total gain. Remember what the total gain was? It was $50,000. So $6,000 of the total gain, all right, is Section 291. It's ordinary income. That's the recapture. Section 291, ordinary income. All right. Now, the total gain was $50,000. $6,000 was ordinary income, Section 291. So therefore, the balance of the gain is Section 1231, which is what? Long-term capital gain, Section 1231 gain. Now, if this was Mr. Thayer, not Thayer Corporation, if this was Mr. Thayer selling this real estate, then there's no recapture under Section 291, because 291 only deals with a corporation selling real estate. So if this was just Mr. Thayer selling this building, there is no recapture whatsoever. None of the gain is ordinary income. Therefore, all right, all of the gain would be Section 1231. Do you know what Section 1231 gain is? It is a long-term capital gain. Section 1231 is a long-term capital gain. Please keep that in mind. By the way, you have to know, all right, when you sell certain types of assets in a business, trade a business, how much of the gain is ordinary income and how much is long-term capital gain, even though it's not a capital asset, all right? So please keep that in mind, all right? These are things you have to know like that, and it looks like no one responded, right, Megan?
Nope, no winners on that one.
God, no one likes coffee, all right? All right, now, let's move on here. By the way, I'm just giving you an idea, all right? The other Section 1231 asset, all right, is tangible personal property used in a trade of business, like machinery and equipment used in a trade of business held for more than 12 months. That's a Section 1231 asset. And, all right, when you sell machinery and equipment used in a trade of business at a gain, and it was held for more than 1 year, did I say 1 month? 1 year, all right, that's called the Section 1231 asset. And don't forget, the amount of the gain that is recaptured as ordinary income for that machinery and equipment is under Section 1245, which is all the depreciation taken is first treated as ordinary income of the gain, and then the balance of the gain is Section 1231. All right? All right, let's go to a financial accounting question. Let's do that. All right, now, first of all, let's talk about IFRS when it comes to inventory. All right, the question is this: what inventory method is not acceptable under international financial reporting standards? And the answer is, it is LIFO. All right, LIFO is not acceptable under IFRS. All right, but it is acceptable under GAAP. All right, now, the next question is this: how do we value inventory, all right, under LIFO, under GAAP? How do we value the inventory? And the answer is, LIFO, we value it at the lower of cost or market. All right? Now, the other methods, FIFO, specific identification, and also average cost, those methods are now valued for GAAP and also for IFRS using the lower of cost or net realizable value. Make sure you know that stuff. All right? And by the way, net realizable value is defined as what? Selling price minus the cost to dispose of the item. Make sure you know how to value inventory now. That's been a change on the exam. Okay? All right? Now, the next one, all right, is they like to give word questions. And the reason for that is people have trouble. We're accountants by nature. It's easy to work with computational questions. So here is a word question on actual inventory valuation. All right. Now it says here, the original cost of inventory valued using LIFO is above the replacement cost, and the replacement cost is above the net realizable value. Under the lower of cost to market method, all right, as permitted for LIFO, the inventory should be valued at what? All right, now remember, for GAAP, LIFO values the inventory under the what? Lower of cost or market. Now, that means that to determine what your market value is, take your original cost and put it aside, because lower of cost or market says the market has a range, which means that the range says that the market value cannot be greater than the ceiling. All right, the ceiling is the net realizable value, and it can't be less than a floor, which is the net realizable value minus the normal profit margin. Okay? Now, if the replacement cost is above the ceiling, you got to bring the replacement cost down to the ceiling, and now your market is no longer replacement cost, it's called net realizable value. And if the replacement cost is below the floor, all right, then you have to bring it up to the floor, and now your market value is called the net realizable value minus the normal profit margin. Now, in this word question, it says the original cost, if you can picture this, all right, is valued above the replacement cost, all right, the inventory's replacement cost is above the net realizable value, all right? So the cost is above the replacement, if you can picture this, and the replacement is above the ceiling, the net realizable value, all right? So now, all right, we put the original cost aside, all right, and we take the replacement cost. The replacement cost is above the ceiling. So what do? You bring it down to the ceiling, and now replacement cost is called net realizable value. Now, the original cost is above that net realizable value. So therefore, if it's valued at the lower cost or market, and the original cost is above the ceiling, the net realizable value, then you're going to value this at the what? All right? All right? You're going to value this at the net realizable value. All right? The net realizable value. Okay? Does that sound right, Megan?
Sounds right. That's it.
And we didn't have any takers on that, did we?
Nope. All right. We're going to shift over to BEC.
You know, I think just for purposes of time, okay? All right? Yeah, let's go. Let's do a BEC. You know what? Let me do the auditing one first, okay? Can I do that? Let's do the auditing. All right? Now, a lot of ethics is asked on the exam in two areas. Ethics is asked in the auditing part of the exam, and also it's asked in the, the financial accounting part, professional and legal responsibilities. Now, when it's asked in the auditing part, a lot of the questions deal with, independence, all right? Did something that was done by the client impair the objectivity, the integrity, and the independence of the CPA? All right, now, here's the situation, okay? It says, which of the following situations would not impair objectivity, integrity, or independence with respect to an audit client? All right, now, let's look at the choices here. You only see one here, right? All right, they are, let me get these. All right, tell me if you think this is going to impair independence or make you not objective. First one, letter A. If the auditor takes the client's audit committee to Las Vegas for the weekend, all right, well, first of all, if they take you to Las Vegas, that's not something that a client would ordinarily do unless what? They wanted something, okay? That is going to impair your validity or independence, all right? Next thing, an out-of-town client takes the audit engagement team out to dinner at a renowned local restaurant, all right? Now, there's nothing wrong with that. First of all, it says here, the out-of-town client, he's from out of town, he takes the audit engagement team out for dinner. Well, the audit engagement team has to eat, all right? No ifs, ands, or buts. So, hey, if you take them to dinner, all right, that's not going to impair their independence, objectivity, or integrity, all right? So that's the answer. The other two choices were an auditor provides client management with box seats for the season at a Major League Baseball franchise. Hey, if they take you to box seats, all right, you're going to really not want to really annoy the client. And in fact, you might even give them an unqualified opinion where you shouldn't give them one. That would impair your objectivity. And the last one, a client takes the audit engagement team on a 2-day ski trip. What does that have to do with doing an audit? Taking, the audit team on a ski trip. What are they going to do? Mail out their, their confirmations on the ski trip and say, oh, that's part of the audit. All right. Definitely, if they take you out on a ski trip, that would impair your independence. All right. By the way, these are coming from our test bank in case you're interested. And, all right, so that's an auditing one. And then, all right, here is, let's do 1BC, okay? 1BC. And this deals with break-even analysis, all right? And the question says this. Let's get the break-even question.
Yep,
All right, here we go. we have here, all right, is it up here, Megan? No.
No.
Yes, here it is. All right, it says Pinecrest has variable cost of 25% of sales and fixed cost of $30,000. Pinecrest break-even point in sales was what? All right, now what's the formula to determine break-even? Well, break-even is really defined as the number of units you have to sell to cover your fixed costs. That's really it. All right, so here's the formula. You take your fixed costs and you divide that by your contribution margin. Remember that. That's to get the break-even in dollars. All right, now, in this information, all right, what are our fixed costs? $30,000. Now, we divide that by our contribution margin. All right, our contribution margin is our selling price minus our variable cost per unit. All right, well, if our variable costs are 25%, all right, the selling minus the 25%, all right, equals 75%. So if you take your $30,000 fixed cost and you divide it by, actually, all right, your portion of the cost, which has to do with your fixed cost per unit, all right, 30,000 divided by your fixed cost per unit, 75 cents, will equal $40,000. All right, so your break even in sales is 40,000, right? Answer C. All right, but anyway, these are just some examples. Now, if you really want me to go over certain things, all right, you got to write in. You got to write in. All right, now, tell me exactly what you want us to do. All right, we'll be doing webcasts. I'm willing to do that. We got actually a fairly good turnout for that. 40 people watched that and they liked it. All right. And also we can still do these, these, what do they call these? Facebook Live things. All right. But what I'm doing is take advantage of everything we do. We want you to gain knowledge so that you can go in and pass the exam. And once again, don't forget February 15th. Don't forget that, the ASCPA is doing actually a webcast on the blueprints. And by the way, all right, they have actually amended some of the things in the blueprints effective for July of 2018. All right. And you might want to look at that. Just go to the AICPA website. You can get that. But make sure, all right, if you don't watch it live, then watch it either way. But watch our webcast on the blueprints, because the blueprints will determine whether you will pass this exam or not. Honestly, all right? Don't go by over and over again. Do questions, do questions, do questions, all right? You don't want to do a million questions. You got to know the material so you can plug it into the information given, whether it's multiple choice or task-based simulations. Okay? Well, I want to thank you for the 25 minutes that we were able to meet with you on a beautiful Saturday. It's beautiful here. It's about 60 degrees. All right. But that's not going to last too long because tomorrow's going to be rainy here. So actually, that's a good day for studying. I always pray for rain for the students because that's a good day to study. All right. But please remember, any questions, you can call me. I'm here to help you. And you will pass the exam. Think positively. All right. And you will pass this exam. It's a very passable exam. And I know you can do it. I really do. All right, ladies and gentlemen, take care, be well, and happy studying, and study hard. Thank you.